Today, I'm going to reveal the secret formula that we use as loan officers so that you can figure out how much loan you can actually qualify for without even pulling credit, without even doing a loan application. All you got to do is watch this video, follow the formula that I will give you, and it will tell you basically how much you qualify for. Now, keep in mind, the only real way to figure out, the only way to actually truly get pre-qualified is to take a loan application. So if you're ready and you know that you need to get pre-qualified, skip the rest of this video and just go straight to the description of this video, and there's a link to my website where you can go and apply for a full-on pre-qualification. That way you can figure out exactly how much you're qualified for. But for those of you who aren't quite ready, maybe you don't think you can qualify for much, or you've got some concerns about your credit, or you don't think you make enough money, keep watching, because I'm going to give you the exact formula that we use as loan officers so that you can figure out how much of a monthly payment you can actually qualify for, and then we're going to have some fun with it. What I want you to do is, once we know what that number is based on the formula, I want you to look at that number compared to how much you're already paying in rent. Is it higher? Is it lower? So after we do it, hit me up in the comments if it's higher or if it's lower, and then I can talk about some other budget-friendly things to help get that thing higher so that you can qualify for more of a purchase if the number is lower than what you were expecting. But if it's higher, then just hit me up on my website and let's make it happen. If it's very similar to what you're paying in rent already, you could be a homeowner today. But let's get right into it. Let's get into the guts of it. I'm going to talk about a real scenario. This is an actual client. Obviously, I'm not going to use names. So this is very realistic for a first-time home buyer. This is actually a young couple that is under contract to buy a house right now. You're going to need to know a few things in order to do this. Number one, you need to know how much money you make. That should be pretty easy to figure out. If you don't know how much money you make, most of the time it's an hourly or a salary or whatever. For this scenario, we're going to use a combined income of $8,000 a month in income. So let's say between the husband and wife, they make $8,000 on paper. The other number you're going to need to know, and again, if you pull credit and do an application with me, I can tell you this, but if you're not ready for that, you're going to have to figure this out on your own. You need to figure out exactly how much money you have going towards monthly payments that get reported to your credit. So I'm talking about things like your auto loan, student loans, credit cards, lines of credit, anything that has a monthly payment associated with it that gets reported to credit. I don't care about the balances. I don't care if you owe $80,000 on your vehicle. All we care about for this exercise is how much the monthly payment is. So if your car payment is $500 a month, write that down and we're going to start totaling it. So let's get into the debts for these guys. They have an auto loan, $350 per month. The next, student loans, totaling $200 per month. Then we've got another credit card that has a minimum payment of $100, and that's important. Make sure you're plugging in the minimum payment, not what you actually pay. Most credit cards, they have like a minimum payment requirement. So like even if you owe, like $80 or something, it usually has like a $50 payment attached to it. So whatever that monthly payment is, that's what we're looking for right here. So for this example, again, this one had a monthly payment, the first credit card of $100 a month. They had a second credit card with a payment of $150 a month, and a third credit card with an additional payment of $100. So do the math. 300 plus 200 plus 100 plus 150 plus another 100 equals $900. Now we know how much debt we have, which is $900 a month that is leaving, it's gone, it has to go to pay those items every month, and then $8,000 a month in income. Now, here's the secret special formula. This isn't exact, but it's going to give you a really, really close idea. Again, there's going to be other credit score requirements. There's going to be, depending on the type you're looking for, how much money you're putting down, the loan program, a lot of variables to this, but this is a great baseline if you truly have no idea what you might qualify for. We're going to take our $8,000 a month in income, times it by 0.45. So in this scenario, $3,600. We're not done yet. We already know we have that $900 in monthly debt. We're going to subtract that from this number. So our $3,600, we're going to subtract $900. That leaves us with $2,700. That is how much of a mortgage this family can qualify for. They can qualify for something that has a monthly payment of $2,700 or less. Obviously, you don't have to go up to the full amount, but that is potentially what they can qualify for on paper. What does $2,700 a month equal in a purchase price? Well, for these guys, they've got pretty good credit. It's in the mid 700s. So they're going to do a conventional 5% down program because they are not first-time home buyers. So 5% down on a $400,000 purchase price with your taxes, your insurance, the HOA, everything included, puts us pretty much right out the door at $2,700 per month. So in this scenario, with all those numbers, you now can qualify to purchase a $400,000 home. And that's it. That's the simple math, right? So I'd love to hear what your numbers are. Again, hit me up in the comments if the number after you did that calculation is higher or lower than you're currently paying in rent. Because if it is higher, that means that you can qualify for more than what you're actually paying for in rent. And I've got a whole nother video about this, but the rent versus buy, the math is crazy. So many people think, and the news is one of the worst culprits, they keep saying that it is more expensive to buy than it is to rent right now. Sure, if you look at maybe a 12-month situation, but we all know that rent doesn't stay the same. Rent will go up depending on how long you're going to stay there or if you have to move around a lot. Rent is constantly creeping up. Whereas with a mortgage, it's like the opposite of rent. Typically with rent, you start out with, a pretty decent monthly payment that you have to do. And then as the years go on, they keep increasing it. Cost of living goes up. You know what I'm talking about. That's why you're here listening to me, because you want to get out of the rent cycle. But with a mortgage, it's a little bit different. Your first year, especially if you're a first-time home buyer dealing with limited funds, you don't have a whole lot of money to put down, that's normal. Your first year, your mortgage payment is probably going to be the most expensive it's going to be because number one, rates are kind of a little bit higher in our current environment right now. They are trending downwards, but that higher interest rate is going to create a higher monthly payment. As long as you know you can handle that payment, and obviously you have to qualify for it. We're not going to get you a loan you can't qualify for, so that's easy. But if you do, just know that your first year is typically the most expensive, and then after that, you have options. Almost nobody hangs on to their 30-year mortgage for 30 years. I've had at least 5 or 6 30-year loans. I've never gone the full 30 years. Just keep that in mind. A lot of people get scared with, sticker shock when they see that monthly payment, like, oh, that's how much I'm gonna have to pay for 30 years. Just know nobody pays them for 30. Like, you're gonna deal with it for a year, maybe 2, depending on what happens with interest rates, and then you can refinance, especially when you're doing a minimum down or less than 20% down. You're paying extra things on there like mortgage insurance. And once the equity is there, once the value increases in your home, you can just refinance and get rid of that. Even if rates stay exactly the same, that's in some cases a $200-300 a month savings that you could be doing just by refinancing to the exact same rate. What I'm saying is you've got options. So if you want to find out truly what you qualify for, the official real deal, like I said, right in the description of this video is a link to my website. You can go in there, create an inquiry, set up a time with me if you'd like to talk about it first, or if you're ready to go, you want to find out exactly how much you qualify for, you can start that application immediately. I have a great system. It'll go in there. It's super basic stuff, name, date of birth, social, where you work, not complicated information. Should take you 10 or 15 minutes to fill out. Once you submit it, it'll ask you to upload some of your income and asset documentation. And once that's done, me and my team can go in, schedule a call with you and tell you exactly how much you can qualify for. Or if you don't qualify for anything, we'll set you up on a plan and we'll make it possible. I had just another one of those earlier today. We got a guy, he didn't really fit into any of the boxes right now, but we found a solution that would work for him a couple months down the road. If you're curious about what you could potentially qualify for, give me a call today, check out my website, let's schedule a time. We can make homeownership happen for you. It's a lot easier than you think. But for now, start with these easy numbers. And again, hit me up in the comments if your payment was higher or lower than what you're actually paying in rent, because I'm curious, I'd love to know.